Happy New Year, everyone. On behalf of the Counselors of Real Estate, welcome to this special presentation of Emerging Trends in Real Estate 2026. Thank you for joining us. My name is John Bucheski, CRE. I'm the Global Chair of the Counselors of Real Estate for 2026 and the President and Founder of Real Estate Fiduciary Services in Somerville, South Carolina. The Council of Real Estate is a global organization of commercial property advisors and has long been a beacon of thought leadership and problem solving in our industry. The organization's strength lies in the diversity of our thought and experience among our distinguished members, those that have earned the prestigious CRE designation. Please visit the CRE website for information on how to subscribe to our publications and to review the membership criteria to determine whether you too might be appropriate as a candidate to join our organization. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed and we'll answer as many questions as time allows. Today, we're fortunate to have Andrew Alperstein, CRE, a partner with PwC, and Chuck DiRocco, CRE, PwC's Director of Research, share the findings of the widely read and respected Emerging Trends in Real Estate report. It is jointly produced by the Urban Land Institute and PwC and is one of the most comprehensive real estate and land use reports in our industry. I'm particularly thrilled to welcome Andrew and Chuck, as I happen to know both, and am just delighted that they were willing to do this for us on this occasion. So at this point, I'll turn it over to Andrew and Chuck. Let them introduce themselves briefly and walk us through Emerging Trends 2026.
Great. Thanks, John. We're going to jump right in. And Chuck and I will kind of do a little bit of a tag team here where we'll face off on different slides. But let's maybe orient everyone just in a little bit of what the publication is for those who don't know. We're in year 47 of this publication that we jointly publish with the Urban Land Institute. The way the publication comes together is we combine over 1,000 surveys of individuals with interviews, in-person and virtual interviews of over 500 additional individuals in the industry, and that's just in the US. And the intent is to really focus on what's coming next. This is intended to be forward-looking. It's intended to be trend-focused, and to the extent we can be provocative when appropriate. So with that, Chuck, do you want to jump into the next slide?
Yeah, absolutely. Again, thanks for having us here today and good afternoon. And as Andrew said, we take a lot of information put together and we always find one of the most difficult parts is kind of coming up with an overall theme. And when we kind of stepped back and we looked at these 500 professionals that we've interviewed, we really got a lot of mixed emotions. Some felt that the reset was going to be over, the commercial real estate's already absorbed the interest rate shock and the easy parts were kind of behind us. Others said, kind of, here comes the mess. You got sticky inflation and higher costs and uneven policy. We have to kind of face it. In 2025, we've seen a lot of change. So the 2026 opinions, we think, took that into account, and we felt overall that the confidence was fading. That's kind of where we came up with this limited visibility and this fog kind of theme overall. We know we're not the first ones to ever use the fog theme before. I know Jerome Powell just mentioned it in October. He said if you're driving in the fog, you should slow down. And he was talking about monetary policy, but we thought it was appropriate for really the feedback that we were getting from our clients as well. And when we look at the fog, we think there's three things that kind of stand out. One is tariffs. We think there's a lot of the reverse globalization and pushing up of prices. Second thing is migration. We're seeing a lot of slowing mobility, shrinking labor base, and it's kind of making the U.S. a little uncomfortable. It's an opinion. And interest rates too. Cuts have started to happen. The majority think that's good, but inflation could actually run higher for longer. So I think when you take those three things into account, we kind of have this cautious mood. We felt that momentum is kind of out, discipline is in, and hopefully this deck can kind of show some more, of that insight that we got from our clients out there. Let me go to the next slide. And when we talk about that, we wanted to step back and kind of see where things are at right now. And this is almost like a split screen economy, this slide. If you look at the top line, the orange, its profits are kind of up and to the right. The bottom three lines are all confidence or sentiment benchmarks, down, and they really haven't gotten back to where they were in 2020. They've kind of had this hit, and it's just kind of been a hangover since then. I think what it's saying is companies are fine, but households don't really feel the same way. Small businesses maybe a little steadier, on that benchmark. But again, when you look at the sentiment and the forecasts, really nothing is really improving except for profit. So again, there's just concern. It's a strong corporate engine is what we're seeing, but this kind of cautious mood. And when we step over to the emerging trends survey results, we kind of saw the same thing. The profitability outlook, which is one of our questions, and this is our participants. And by the way, if you see a little fog in the corner, that means anything. That's everything that came from the actual survey, since that was overall theme. And what you see here is the majority expected solid performance or good to excellent. There's a little bit fewer in range than it was last year. The fair trended up a little bit. And since 2022, we feel that expectations have kind of fallen. So again, what we're going to talk about, I think, in this deck is we think that, and what we heard is that discipline is going to replace the 2025 exuberance. It's what we talked about a lot in the last report. And we think it's really about balancing of growth and controlling of costs. Andrew?
So let's Chuck already mentioned interest rates being one of the kind of key drivers of some of the fog theme that we talked about. When we entered 2025 and when we did the publication towards the end of 2024, the expectation was we had an election behind us. We were expecting rate cuts. And there was a lot of optimism around both transaction volume, valuations, and largely driven by moderating interest rates. Obviously, that hasn't really happened. We've been stuck in a 10-year Treasury band of kind of 4 to 4.25 for it feels like many months now. And that's really part of the reason why we're seeing this kind of hesitation and level of uncertainty is we haven't been able to, really move the needle on borrowing rates. That being said, we'll talk about how the debt markets have changed, the availability and cost of debt. But from a fundamental base rate perspective, we haven't probably seen the downward movement that we had hoped a year ago. We've obviously had some interesting Fed meetings this year. We've got Jerome Powell there in a hard hat because he certainly has enough abuse hurled at him, but he just has a couple months left. There's obviously a lot of uncertainty with respect to his replacement, the role of the Fed, the operations of the Fed. But the expectation, having got the 25 basis point change in December, is that we're not expecting, or at least 83% of folks are not expecting a change coming up here. So we're obviously all watching this really closely, but relative to a year ago, we didn't see the downward movement that we hoped in the 10-year Treasury. Now, on the right, again, this is from the survey, and what we're showing here is survey respondents' expectation for all-in mortgage rates for 2026 and then for the next 5 years. And you can see the majority, close to 60%, are expecting decreases both in 26 and over the next 5 years. That hasn't changed much from the prior year, by the way, and I think that's still the way we're hearing and seeing folks underwrite and set their expectations around borrowing rates. So hasn't changed much from a sentiment perspective. And again, we'll touch in a minute on just some of the feedback on the debt markets. So Chuck, on to the next slide.
Yeah. So one of the other things that we wanted to talk about as well was kind of, the inflation aspect of things and tariffs. And this is kind of an update that we threw into the publication as well. I mean, we've talked about eggs for probably the last 3 years, and now we're talking about beef prices. So let's take a look at really what inflation's about. So we took a took a exhibit and put it together here, which is the CPI, which is the orange line. Prices have basically doubled since 2006. If you look at nominal wages, they kind of fallen at the same direction, but maybe not at the same pace. They've lagged prices. And the real thing that's important is the gold line. It's the CPI adjusted, or the real purchasing power, kind of what you actually can buy for what you're making. And it's improved modestly, but look at see the big trail. And I think that that's what we're seeing in the economy. Consumers feel that, their paychecks are bigger overall, but they're not able to buy more, and you're hearing it. And it's not really all inflation, though. That's where it kind of goes. A lot of that is wage growth as well. And I think that's something that we wanted to put together and show. And as well, we looked at it on the tariff side. Tariffs really aren't simple. Effective rates, you see them anywhere from 15 to 18%, the largest, I think, in 90 years. The big question, of course, is who pays, what gets passed through. And I think in practice, it kind of lands to the consumer, as a whole. So it's going to hurt household budgets. But what we decided to do was look at a range of incomes, low, middle, and high. You have the costs in dollars, and the dots are percentage of the share of income of these results. And you have to think about it. Rates really aren't unfair. If you're paying 25%, Andrew's paying 25%, and your neighbor's paying 25% across the board, what really happens is it hits the low income households the hardest. And that's really what this chart's about. Think about it. If the example of if groceries have a 15% tariff, are groceries 5% or 20% of your budget? And that's where we get into really talking about regressive tariffs. And the bars really show who feels it the most. You can see it on the low income side. And we think this is just supports, unfortunately, a bit the bifurcation of spending that we've talked about now for years, that we continue to see moving forward. Wages buy less, and tariffs are kind of magnifying that gap. And we threw it actually in the survey. We just threw this additional question in this year, and we kind of said, does the tariff policy add market uncertainty, to you as an investor, in the coming year? 90% said moderate to high. I don't think I'm really surprised about it. A couple updates I guess you can throw out. We know that the Supreme Court is talking about if Trump had the executive power, to actually do what he did with, with the tariffs. You hear that they're leaning maybe against him. You have large companies that are filing suits against the government, and talking about refund lawsuits. So I think this is going to be a topic that is going to continue to be kind of at the front, into 2026. We heard it from our clients as well. So we just kind of want to give a quick update on that.
Important. We'll touch quite a bit on kind of labor, and the demographics of the U.S. population and the impacts that it has on our industry. Probably the key takeaway on the left here is I tend to focus on the green line, but I'm going to start on the kind of yellow line. That's unemployment, and we've seen that ticking up since the middle of 2022. Still at pretty moderate levels in the fours, but it has been ticking up. The red line is wage growth. Chuck just talked about that, has kind of moderated, and he discussed just the affordability piece of that. When we layer on the green line is the jobs ratio. So that's available jobs to number of unemployed. And you can see how that has shrunk from close to 2 back in 2021 to even just below a 1.0 ratio as of recent months. And so what that's telling us is that job market that was so frothy a couple of years ago, particularly driven by some of the tech companies, that has really subsided. And we're moving from this concept of kind of job hopping to more of a job hugging, is how we've heard it framed. Really to acknowledge that the job market is not nearly as robust as it was. And it's a combination of that increasing unemployment rate as well as some demographic factors, one of which is impacted by immigration policy. So what we've got on the right here is a chart showing us the states that are most impacted by foreign-born construction workers, and obviously that's a big part of our industry in terms of labor for construction and associated projects. And maybe not surprising, Florida, Texas, California have the biggest impacts. And so we were talking about this in previous years, but it's become much more pronounced with some of the immigration policy changes, is what do we see happening with immigration policy, specifically in those states that are most correlated with immigration. We'll certainly expect to see some pressures on labor availability and labor costs. And it's not just construction, it's many other sectors as well, agriculture, food and beverage, and so on. But this is something that certainly was unexpected a year ago. And it's something that we all need to keep an eye on because it not only changes migration patterns, but it's this component of the labor story that's so important, particularly in an industry that's so tied to construction.
All right, so let's jump into the trends in the publication. So those first, that introduction was kind of updates some of the economic benchmarks that we want to talk about. I think that's going to support kind of this discussion moving forward. Our first trend is, and these aren't in any particular order, demographics will define, demand. And what we really talked about here and what we heard again from our clients is that real big concerns on the U.S. workforce growth and kind of how things are going to be moving forward in finding labor. And this here is a chart on the working age population, 20 to 64. You can see it's near historic lows. We went from 2 million annual gains to basically flat today. We really consider it to be a structural change, and we'll talk about that maybe in some more detail as we move forward. And the big concerns that kind of stand out when we step back and kind of digested our interview results was aging, fertility, and policy change. And I think the aging is pretty simple. Since 2010, the baby boomers are retiring faster than they ever have. If you look at the fertility side, there are fewer young entrants each year that are getting into the workforce, and that's because the fertility rate is down. It was 1.9, children per family in 2010 to 1.6 in 2024. So it's a 15% drop. That's going to have an impact on the labor market and possibly on the economy as well. And the third thing, of course, is immigration. In mid-20s, it was low. Temporary lift in 21 to 23, and then it died again in 24 and 25 because of these policy headwinds that we hear about almost on a daily basis. So demographic tailwind is kind of faded. And I think when you add, and Andrew and I have talked about this, when you add one more piece to it, there's a lot of onshoring pushes and promises and agreements that you're hearing about. It should be a great boost for commercial space, you would imagine. But what about the workflow, the cost? Do we have enough people who wants these jobs? And we think that that's another thing to kind of keep into account, with these big plans that you're constantly hearing on a regular basis. So again, the demographic drivers were big. And then we wanted to look at it in one more depth. And we decided to say, well, let's look at the U.S. born population turning 20 and those that are turning 65. When you look at it, look at the change. It's roughly the same. It's almost 1-for-1. So I think when you see this, there's just as many leaving and entering at the exact same time, and we need obviously more in the labor pool. So I think every sector is kind of fishing in a sinking pond. In immigration, we really believe, and what we heard, we feel that is the only lever left with pool. Without it, the workforce is going to shrink, and we do believe that future limits are going to be set by this demographic growth. And if we dive just a little bit deeper into it, and kind of look at it again, this is focused again on the working age population growth. And we kind of just jump out to these forecast pieces. In this chart, you have two scenarios. If you stay to the normal immigration that we had in 2010 to 2019, and the workforce is going to grow modestly. And I think we would be very happy with that. If you have no immigration, you're going to have contraction in the workforce. And, it isn't necessarily the sole driver of the economy. Boy, it is a big piece of the growth as a whole. So we do think that demographics set the floor. The policy is going to set the ceiling of it. And we need to find an answer because the impact is going to be, it's going to have an impact on the economy or housing or commercial real estate itself. So definitely something that came up on a regular basis. When we get back to our survey results, it was pretty interesting. We asked, what are the most important social and political issues? Number one, immigration policy. Over half, agreed with that. We said, what's the important real estate and development issues? It's labor costs and availability, which kind of falls in that same line, almost 74%. And if you look at number three, and I think this all kind of ties together, political extremism was number three, a lower percentage, but it still came up third overall. So it's definitely something that we had to mention. And, labor demographic came up over and over again. So, Andrew?
Yeah, yeah, just going back to the labor pool point, there are folks who strongly believe that AI will be part of that kind of solution. There's a lot to unpack there and a lot to figure out in terms of what are some of the jobs that might get absorbed by AI. And we continue to see a job market that where there is a mismatch between the skills needed and the skills available. So in addition just to the gross numbers, there's obviously layers below that in terms of um, what what can technology really do, and then do we have the right skills to match what's needed. So, and we'll talk about AI in a couple minutes. But on the capital market side, Chuck, if you want to move to the next slide, there's quite a lot on this page. We've got a couple quotes at the top. I'm going to orient everyone on the left-hand side. So we've got kind of two pieces of feedback from the survey here. So the one is around equity capital, um, and really talking of, getting feedback for 2026 on um, the kind of availability of equity capital, both for acquisitions and then for development. And you can see that it's I wouldn't say it's in balance at all, because we've got some of oversupplied, we've got some undersupplied on the acquisition side, but it's certainly not compelling. Um, and when we look at um, the debt version of this, it's much more kind of in balance. And you can see obviously on the development side, we're still, pretty short, not surprisingly, given the excess supply we've seen in certain markets and property types, the cost of labor and cost of construction. Um, but it's an interesting feedback piece to track year over year. And then down on the bottom, we're talking about debt underwriting standards. And here you can see the notable improvement. Depends whose view, I suppose, you look at, but you can see the more rigorous section, which is the orange, has been shrinking since 2023. So lenders getting less rigorous, if you will, um, and more kind of in balance and reverting to more traditional levels, which is obviously positive. The chart on the right, we're going to talk more about acquisitions on the next slide, but the takeaway here is that the length of each of these bars really reflects transaction activity in each year, and then above the zero line is um, acquirers, and below the line is 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 sellers. There's been a lot of fluctuation year over year in terms of the sources of capital. And you can see particularly the institutional equity funds, which really ramped up in 2020, 21, 22. And you can see how the public REITs have been kind of net sellers. We've also seen some of the private and cross-border activity as well. We're going to talk more about investments and activity on the next slide. So Chuck, maybe we'll move there. So, acknowledging the fog and uncertainty we talked about on the left-hand side, we have seen a 17% increase in quarterly investment activity year over year. So that's Q3 of 25 to Q3 of 24. That's obviously positive, but we're still well below the levels we saw in kind of 21, 22. On the right-hand side, we're talking about the availability of capital, looking at current year versus prior year. So on the previous slide, what we just talked about the equity availability. Now we're talking about both debt and equity, but year over year. So this is from a survey perspective, how do folks view these different lending and equity sources this year versus 12 months ago? And you can see certainly on the lending side, a lot more positive in the current year's publication than a year ago, and that is consistent with everything we've been hearing in terms of spreads coming in, banks being back, CMBS being active, debt funds still available, lots of private capital, and lots of talk about private capital helping fund and support that. The one exception, obviously, at the bottom is the GSEs, which are down relative to the prior year, and a lot of that is just the uncertainty around what then administration might might decide to do with the GSEs. On the right-hand side, you can see a much more moderate improvement, generally speaking, um, and kind of highlights that uncertainty, kind of foggy theme that we've stuck with. Not a lot of movement from a equity source perspective, especially relative to the debt side, which has notably improved relative to a year ago.
All right, the next trend is kind of back to basics where analytics meet operations. And when we kind of put this one together, what we really heard, it wasn't, it's not all a pessimistic view and not that necessarily confidence is completely fading. What we're really hearing too, again, from a lot of the participants was, well, now we're going to have to focus on operations. And that came up regularly in the interviews, and we saw some of that in the survey results as well. So we kind of sat down and stepped back and thought about like, well, how can we maybe show this, that this is kind of the direction that things might be going. And when you look at it historically, the economy expands, it stalls, it restarts, and we really feel that productivity kind of defines a lot of that direction. So what we decided to do was look at the real GDP growth, which was shy of about 25%. This is over the 2015 to 2024 period. So it's about 2.5% annually. And we said, all right, well, let's look at productivity. And we looked at that and it kind of lagged. I think that makes some sense in about 1.6% annually. Historically, the average is around 2.1%. So it's really one of the weaker periods we saw since World War II. And it was just something that kind of stuck out. And we said, well, why does this matter for commercial real estate? Well, when you think about it, if it's slower productivity, it's going to limit space demand, you would think. The economy is still going to grow, and a lot of that is consumer spending because that's 70% of GDP. So real estate has to kind of somehow support that growth with basically providing more output in the same footprint. And really what that means is then is the result would be GDP is going to grow faster than commercial real estate inventory. And when we kind of, again, put the data to it, it showed that. And it was kind of interesting when we talked about this. And this is really GDP versus commercial real estate inventory. And I indexed both of them and kind of ran it forward. And you can see in the beginning, it's kind of this lockstep period, 2000 line. Both, move together. Both lines look the same. I think it's the old real estate playbook. I've been in the industry, I guess, now for about 25 years. It's like if the economy's grown, we're going to build it. Maybe we'll overbuild it, but we'll deal with that later, and that's fine. Then you got kind of 2008 and 2009 was the great financial crisis where the construction virtually stopped. And this is what we kind of called the Great Divergence. And this is where the economy recovered quicker than we thought, I think, but building really stayed constrained. Never really returned the lines, and they kind of continue to separate. And we really felt that that's not a temporary change, but I mean, that was a structural change. And maybe this is the new norm, which we have a tendency to use a lot in the industry. And then we started to look at that forecast of it and said, all right, what's going to happen? We kind of called this the permanent separation. So this is where the lines diverge dramatically, the forecast widen the gap. You have supply constraints are even tighter. Productivity gains are reaching new levels with the technology that Andrew mentioned earlier. And you kind of see this operational productivity in commercial real estate. And the goal there is to capture that economic growth with tighter and tighter supply. We think that's kind of that direction. So, the decisive advantage, and it's kind of old school in its sense, it's location and quality. We've said that forever, but now we think it adds another component, which is functionality. So we think essential real estate is going to survive and thrive in this kind of efficiency-driven economy. And we kind of threw a bar chart. Again, it's really saying the same things. It's just putting some numbers on it as a whole to see the separation of these groups. And if you get out to the last bar itself, you can see this efficiency really accelerates. It's kind of the highest gap in modern history that we've seen when comparing these two data points. So we think that, again, the economy grew without proportional space, and we end up getting more output from the existing buildings. So we're like, all right, this is pretty cool. Why don't we take it another step further and jump into it? And we did. And we looked at it, and we took a deeper dive, and we started to look at the sectors. So we said we tried to compare every property sector to the proper GDP, except for apartment. And we'll talk to that in a second. And when you see almost every property sector, efficiency replaced expansion. So it's the same thing we saw when we did the aggregate. So it's no longer about adding space, it's making the right space work for you and making it work harder. We've talked about it, you've heard about it, but now you're kind of seeing the numbers, office, the flight to quality, retail, physical stores, we're moving to showrooms now and service hubs, industrial, logistics revolution, proximity to population. Multifamily. The one partial exception. We couldn't do it with GDP there, so we actually did it to household formation, and there it's the reverse. Apartments are greater than household formation. So it wasn't a volume problem. What we feel there was a mismatch problem. So now performance is now split by quality and location. So this could be one of the variables of the affordability crisis. We're building apartments, we're putting a ton of them out there. The sector's calmed down over the last year or two, but maybe we're adding units kind of in the wrong places at the wrong price points, things of that nature. So again, we think, again, productivity evolution, and again, we heard it from our participants, is really important theme moving forward, more with less space. And that was something that just really kind of stuck out overall. And maybe AI has an impact on that space as well, then, Andrew.
Yes. So on the next slide, um, we didn't have a single interview conversation without AI coming up, and the range of topics was broad. Our view, and I think the view of a lot of the folks that participate, is AI is going to reshape how work is done, not as much replace. A lot of the headlines around replace, but a lot of this, especially in real estate, we think will be reshaping. Now, what is interesting is we got some data on where we're seeing the most prominent use cases. And maybe not surprisingly, residential or multifamily is one of the higher kind of utilizes, and it makes sense, right? You've got daily pricing, you've got lots of data, pretty accessible, and a lot of folks have been kind of working towards that for some time, and it's just really accelerated. And you can see some of the other kind of use cases that we've seen, and this translated on the right, Chuck, when you click it up to well, sorry, we'll get to that in a second. Just some other data points around who's using AI most prominently. Um, and so we ended up, as I said, with AI being the second biggest disruptor in the survey. Um, Interestingly, construction labor availability and cost was number one, um, which we thought was interesting, but they were very close, one and two. So this is clearly on people's mind. A lot of folks not looking to be in the lead, but certainly want to be in the pack, close behind, understanding the use cases, how to build the work plan. And there's a lot more to come here, obviously. But this was just a little bit of a snapshot of what we heard and saw.
So staying kind of in this same direction, we talked about productivity, we've talked about operation a bit and some of these trends that we've heard from our clients. Now we want to discuss the next thing, which we think is the change driver, which is cost. Operating costs are kind of rewriting, we feel, real estate performance rules. Insurance, other property expenses. They've gone up two, three times that of inflation. Industrial apartments, huge cost burns across the board. You can almost pick the paper up every week and have something relating to real estate costs and expenses and how they continue to increase. So cost squeeze margins, which we're all aware of, and efficiency, which we've just discussed, and that can't offset the expense growth. And when we go back and we kind of looked at our survey results, we kind of see there over half said it's a problem. It ranked third in the 2026 real estate and development issues. In line, when you look at the economic and financial issues, third was inflation at just under 50%. Fourth was tariffs and trades concerns, but both just barely under 50%. We know both of those are not going to decrease costs. So they're obviously concerned in 2026. So when costs are greater than income, I think the capital looks for more stability. And this is what kind of pushed us to really what the trend's about. It's really is the investors, this is one reason, when there's many, that investors are rotating. They're looking for property types that have durable income and higher returns and essential demand, which kind of discussed in some of the other pieces. And that kind of brought us around to here, this niche to essential real estate. And we decided to take a look at some of the Odyssey Fund exposure data and look at some of these positive flows to new or essential real estate regarding their sector allocation of all the Odyssey funds to see where that flow is over the last 10 years. And when you view this chart, it kind of is interesting when you look at the kind of go from the bottom up. When you're at the bottom, you see the outflow or less allocation to these assets in office and retail, and hotel kind of pops in there a little bit. And then you have this batch of alternative sectors that are all positive kind of in the center. They're minimal. Maybe it's harder to get your capital. Maybe there's into them. Maybe there's less assets. Maybe the cost isn't right. But you do see allocation going into that direction, into other now niche, which could be known as the new essential real estate. I can't say it enough. And we're starting to see this kind of next commercial real estate shift into this sector rotation. We talked about it a little bit 2 years ago. We're seeing it a lot more now at this point, more capital flow to these property types. So we really think now real estate is defined a lot by service and not so much by square footage. So it's something else to kind of note. When you get over here, surprise, surprise, we go back to our survey results. Number one, in 3 years running on the investment and development side, data centers. Digital economies built, talked about AI cloud, the connectivity, but big problem, we talk about it in the publication, need for space and power. And again, it's something you hear pretty regularly on CNBC. Number two, senior housing, hold steady at number two. It was number two 2 years in a row now. Demographics are going to drive demand. Boomers are all turning 80 up. We have limited supply, which I think is pretty funny. I say this a lot in my presentations. It's like we weren't aware that the boomers were going to get older, so we didn't build enough space for them for their essential retirement needs. So that seems to be a real scramble now. So I don't know what everyone was thinking, but some people might have missed out on that opportunity because they're here and they're looking, especially the middle markets of that baby boomer generation. And then number three, medical office, it jumped 8 spots. On the investment rank side, healthcare demand is durable. It's not tied to really a business cycle. It ties with the baby boomers, which we just mentioned. So, each sector shares that same trait: durable income, longer leases, essential services, and what's niche could be the future core. So, I think it's something that, again, I think, Andrew, we're going to be talking about probably for the next 3, 5, 10 years. This is something. This slide, something we're going to have to update. I think fairly regularly.
So it would be hard to get through a presentation without talking about data centers. Our experience in talking to clients and folks that participated in the interviews was there's kind of two camps here. There are some skeptics, and then there's the folks that are either in the space or aggressively looking to get into it, and it's all driven by largely that chart in the top right, which is hyperscaler capex. The numbers are pretty staggering, and that's just the hyperscalers. We've obviously got one primary challenge in terms of new supply, which is power, but there's lots of other issues that are putting folks into that skeptical camp. It's the size of the deals. It's who's the next buyer. It's how does this price. It's the obsolescence concerns. There's a lot of questions that we have not navigated for any other property type in the same way. And so there's a lot to kind of keep an eye on here. But again, all driving off that top right. On the left-hand side chart here, we can see how basically all new supply is getting absorbed almost immediately, and it's keeping vacancies in the US at pretty close to 2%. It's pretty nominal. And on the right, this is looking at where we expect the biggest growth to occur. Or obviously, Northern Virginia, Chicago, and Dallas are already big data center markets, but it's going to be interesting to see where some of those secondary and tertiary opportunities present themselves. As with all real estate, there are skeptics around, do we want to be in Des Moines, Iowa with a multi-billion-dollar data center? It's going to be interesting to watch because that may be the place you can get land, power, water, labor. So there's a lot to kind of keep an eye on here. But again, we tried to balance a little bit of, there's a lot of exuberance here and there are skeptics, and there's a lot to kind of unpack and keep an eye on as things progress.
Staying on the property sector side, and our seventh trend was actually student housing. This one takes a little bit of a different turn for us. Normally, the trends that we talk about are kind of on the uptick. We're in that direction. This one's a little bit different. We really felt that student housing has kind of hit its peak because a trend doesn't have to always be positive. It could actually come in the different direction. So we added this one this year. When you look at 2024, enrollment's up, beds are full. National enrollment was up 4.5%. Student population was greater than 19 million. They added 100,000 students over that time. It's the most since 2015. Federal aid helped a lot. It changed, so it was a big, very strong variable for people getting back into school. Occupancy near record highs. Rents were good. It's led by Southern universities, which we found as well. But what we really felt is that it's really late in the cycle, and it's really at a time where we think it's hit its peak. It's not going to be a new wave moving forward in the coming year. So we think that that was kind of its high watermark. And when we started to again step a little bit deeper into it and look at some of the changes and the peaks from kind of peak to pressure, when you think about it, the student pipeline is going to start to shrink. Costs are continuing to rise. The tailwind is kind of turning. There's a study that we pulled from that said, by 2040, there'll be 13% less high school graduates. I guess everyone's going to become an influencer, Andrew. I think that's the new thing to do. We
No
should look
doubt.
into it. Yes. But when you add in the international enrollment side as well, that obviously hit record levels in 2024. But now you got the visa issue, the delays, it's cutting arrivals by double digits. So again, we just take that, all those, on the demand side, then add in the tariffs for steel and aluminum to put these things together, labor shortage, financing is getting tighter, federal funding cuts. I don't know, I won't name the university, but the Wall Street Journal did a big article on a university that had a lot of debt that was going to be a big concern moving forward. Is actually university debt, very good university too. So we think that developers are going to be pulling back a bit as a whole. When you look at it and we go back to our survey results, I think when you look at that data, I think it makes sense, but we did actually have some respondents, and the majority of them still think there's buying opportunities. Maybe they're thinking farther ahead. Maybe there's something that the data doesn't. 58% or so thought they were fairly priced. I just threw this last one in here. 2.9% don't think it's going to be higher education costs. I don't know where they're going to school, but costs go nowhere but up. So I think that maybe they didn't read the entire question. I don't know. But I think this is one that we actually wanted to throw in because we think it's actually on the other turn, unless things obviously change politically. And I think that that's what could be one of the demand drivers for that.
Moving on to seniors, and Chuck, you want to hit the next slide? Um, this chart on the left is pretty compelling, right? This is individuals in the U.S. turning 75 each year, and you can see that growth clipping away for the next 15 years. This is the quote unquote silver tsunami that we've been talking about for a period of time. We've got a couple of charts here that kind of highlight the opportunity and maybe the challenge really in the space. What is interesting is you look, Chuck, if you go back real quick on the
Sorry,
previous
Andrew. Yeah,
slide on the
sorry.
right side,
That's what happens when
um,
two people are talking and one
yeah,
person's clicking. There's going to be a
um,
disconnect somewhere.
the uh, the proportion of folks that are looking to live alone um, is projected to double by 2040. And that's obviously a catalyst, another catalyst for senior housing. So you're combining that with the demographic numbers, it's pretty compelling. And when we get to the next slide, which you can now click to, Chuck, we'll talk a little bit about supply. And you can see on the left side, we have 56 of the markets that Nick tracks in the US that have no development projects whatsoever. We're at the lowest level of new supply since I think 2006. And you can see that on the right-hand side, we've got the orange bars, that's that population growth rate that we were looking at on the previous slide, historically and then going forward. Oh, and we also had supply very moderate. What's going to be really interesting for the new development that does come online is these topics on the right, because the expectation for these boomers is they're going to be looking for a different type of product to maybe some of the traditional senior housing that we knew about. There's a lot around wellness and lifestyle, technology, and there's going to be this balance of affordability and flexibility. So um, we have a number of clients and folks that we talked to in the interviews really bullish about the sector. The challenge to date has been a lot of the new development has been at the very high end of the market, very concentrated in certain locations. There is a lot of gaps from a supply demand perspective here. It'll be interesting to see how that kind of gets filled, if it gets filled, and how that changes some of the economics around seniors housing. So a lot to positive to kind of keep an eye on.
And yep, we're going to talk about self-storage. I don't think I've mentioned self-storage in my career, but we had, interest in it. We heard feedback from it. We said we think it's a trend because when you actually start to think about it in more detail, the housing market obviously is tight, affordability remains a concern, and it's reshaping a lot of people's use of space. So in 2023, only 8.3% of the households actually moved. It's one of the lowest that we've seen in our study. And people are staying put. They're not trading up. They're handcuffed to the low rates. And again, you see articles like crazy on that. So instead of moving, they're making do and they're finding more space elsewhere. And that's where self-storage kind of fills that gap. 13.4% of households now rent a unit, which was pretty crazy when we saw that data. And you can see with this chart, there's still supply is still pretty active across the board on the right. And when you get down to the results, that makes sense as well. When you look at the survey, third was housing costs and availability at over 50%. So you're kind of stuck maybe where you're at. And that's why these self-storage units might come into play. And when we talked to our self-storage author and we had multiple calls, they pointed something out that I think Andrew and I, neither one of us were aware of maybe at the time, but storage is no longer, the longer boxes and lockers that you see. It's a lot is turning into kind of an ownership, a lifestyle, and this flexibility kind of all in one. So what are we talking about? Maybe you can call them storage industrial flex condos. This comes from a Michigan-based company site. They sell these condo types. They pitch this storage condo theme, a gateway from home is what they call it, which I can't say without honestly laughing inside. A gateway from home. You can rub elbows with others. I kind of highlighted some of the quotes that came directly from their, and no disrespect, they're on to something possibly, but these units are 1,000 to 2,000 square feet. They're sold individually. They're not rented. Typical buyers could be affluent car collectors, hobbyists, small business owners, that need that space. 80% are owned for personal use. 20% use them for small trades or event business. And the user again could be ownership or community. We just heard enough about it. We understood the impact of what housing affordability and being basically stuck in your home could do, and we really thought this was something to talk about. So, it's a commercial real estate product that people are starting to want to own. So maybe it's something to kind of put on the radar. So we thought we'd mention it, but we got to get back to the core. Andrew, why don't you end on number
Yeah,
10?
let's
At
wrap
least
it
the
up.
trends.
Well, second to last. Certainly wanted to touch on office a little bit. We've kind of moved, I would say, from crisis to maybe we'll call it recalibration. We've certainly seen some green shoots, particularly in some of the Manhattan submarkets and certain other pockets. There's plenty of obsolete products still. We're hearing about more conversions, but we've obviously still got a ways to go. And average pricing is approximately 50% of where we were looking at the chart on the right. We've started to see some non-distressed transactions. Again, New York probably being the best case, but there've been a couple in Boston, a couple in Dallas. We continue to be hopeful that those parts of the market will continue to function effectively. The lending market is available, maybe not as readily as other property types, but there are definitely some green shoots. And if we move to the next slide, Chuck. A lot of that has been driven by return to office. For any of you that are in Manhattan frequently, we are back. We do not have enough space in our two offices that we have in Midtown. Our hoteling is not working effectively. We're up 100% multiple days a week, and then Fridays we're still pretty empty. But what is interesting on the right-hand side, 69% of office tenants are looking to maintain or expand, but on average, it's less square footage. And the point at the bottom and the amenities that we'll touch on in a second, if you look at those, the relatively few new construction properties in the U.S. since 2019, they've got pretty good rent growth, and we're seeing top of the market rents in places like in Park Avenue in New York, other parts of Midtown. But it all relates to location, amenities, technology, wellness. and making the space desirable for this return to office bounce back that or trickle back that we've experienced. And then maybe just to wrap us up on office, I mean, and I saw there was a question that came through just about some of the debt maturities in 2026. And office is at an all-time high from a delinquency perspective. Overall delinquency is also elevated. The majority is still office. Um, it came up very, very infrequently in the interviews, which was a little surprising given um, the volume of maturities that are on the books for 26 and 27. Obviously, the lenders are in better shape. Um, it's debatable whether values have completely adjusted, but they've certainly adjusted. And there's definitely more capital available. Um, and because the banking world has stabilized, I think most folks view is it's going to be a long slog to work through those. There'll be some foreclosures and REOs and things like that, but it's been a lot more manageable with a lot of kicking the can and um, some of the treatment in recent years. So on the right-hand side, medical office by far the most favored of the office sectors. In the prior year, we spent quite a bit of time on life science. This is supply demand there is still very challenged. I think most folks' long-term view is still very positive, but we've got quite a ways to go with the supply that was in place and underway as venture funding slowed down, the IPO market slowed down, um, and there's, like I said, a couple of challenging at least years ahead of us in life science.
All right, that was our top 10 trends. I know it's a lot of information. It's a lot of thought leadership in that publication, but we got to go jump over to one of my other sections here that I enjoy. Why get to the big there? Can you still see the slides? 'Cause
Oh, we lost it.
something popped up. I don't know.
We lost it, Chuck.
All right, give me one sec. I don't know. Andrew, your head got really
Well,
big.
yeah, no, we don't. No one wants that. But what the next slide is
No.
going to be, I'll tee it up while you're pulling it up.
Yeah, go
So,
ahead. I gotta find where it's at. Thank you.
um, every year we based on the feedback we get in the surveys um, and supplemental work that we do, we do a um, top 10 markets in the U.S. It is something that gets a fair amount of attention, particularly for the markets that are in the top 10. We get a lot of requests for
Is it
additional
back up?
information and the like. So, Chuck, if you want to walk everyone through it,
All
that'd be
right.
great.
Sorry, I don't know what happened there. Not
And
as.
Chuck, we're at about 8 minutes before the hour,
Yep.
so
Yeah, we're getting to the end
walk
here, John.
walk fast.
Thank you. Um, The top 10 markets, like you said, it's one of my favorite sections. When you look at the investment and development ratings, they were slightly higher actually on some of the markets. Northeast, I think, had the most and the most momentum. South Central, Southeast, a little bit more, but there were six states that kind of stood out amongst the rest. Um, there's always a number one. So we had our 10 markets that kind of stood out that made up our top 10 list. And quickly, I'll kind of drop them out since we talked about so much fog. We thought we'd drop a little sunshine. Manhattan came in at number nine this year, Tampa number eight, Nashville still in the top 10 at number six. This is really what stood out. Brooklyn number four, Jersey City number two, Dallas number one this year. I had the opportunity to speak at Dallas, fastest growing metro, very business friendly. 100 headquarters have moved to Dallas since 2018. Second largest U.S. financial hub. So watch out, New York. They have the Texas Stock Exchange. It's right around the corner. At least that's what they're saying in Dallas. So be careful. But the real thing I think that stood out is the greater New York metro area, four in the top 10, Brooklyn up 10 spots, Northern New Jersey up 22, Jersey City up 17. The affordable access to Manhattan population has grown almost 8% since 2020. And again, Manhattan back-to-back top 10. So I think this was kind of something that really stuck out. And we think it made sense once we got the data. I know we could elaborate on it, but we're short on time. And one slide left back to you, Andrew, before we close.
Yeah. This really summarizes a lot of what we've talked about in the property types as we had folks rank the different um, sectors and subsectors. You can get a feel for how those lined up. Again, data center, self-storage, some of those we touched on up at the top. A number of housing sectors coming next. Retail we didn't really talk about, but bounced back nicely, particularly grocery anchored, necessity-based retail. Hotels have been challenged. There are some green shoots as well, but have been challenged. And then a little bit of a bounce back in office, like I talked about some of the green shoots, and certainly medical office viewed more favorably. And then maybe Chuck to the final slide. There's a lot more information you can get through the QR code and on our website. We've got a digital version and a bunch of additional information. So welcome everyone to utilize that. And with that, maybe John and David will kick back to you to see if there's any questions, or happy to respond to those.
First, let me say thank you to both of you. This has been terrific. It's been very informative. It's been very enlightening in some ways. And I'm thinking about a new location for my man cave because, one of those self-storage units just might do the job. I, we're a little short on time, so I'd like to do one thing. If each of you had the question in front of you, what's one takeaway for our audience from all the things you've said and all the work you've done on emerging trends? And I won't pick on anyone. You can go first if whoever would like to. What would it be and why?
I can go first.
Sure.
Hopefully,
right.
you
Go
don't say the
first,
same thing.
whatever.
I am absolutely fascinated by the demographic shifts and how between policy changes and the aging and AI, just the labor market and how the different elements influence the labor market, and with policy changes adding to that, to me, John, like it's fascinating to keep an eye on migration, immigration, labor market, because I think it fuels a lot of those economies, and by association then drives a lot of the real estate need. There's a bunch of tentacles to it, but I continue to be fascinated with some of those trends. I just think it's so interesting at this particular juncture.
Yeah, I think mine, John, is really goes to the operation or operational efficiency. I think again we talked about it a few years ago, which I think it all ties together, the operational efficiency and this new move to this essential service niche real estate, which we hopefully you're able to take in the presentation. We did that same look. We looked at Odyssey funds this year to kind of see that move to be more essential, more efficient, more operational. We looked at the Odyssey funds this year. 2 years ago, we looked at the NAREIT index. And that has even more sectors and what they represent when you look at the total market cap. So I think that was something that stood out. Again, something we heard from our clients, and I think that's what we're going to see moving forward.
Thank you both. I certainly think that what's happening with the labor markets and what's happening with a renewed focus on operations, where sort of all the underwriting we see these days is not assuming that capital markets are going to be a big contributor to overall returns. So on that note, let's call it here at a couple minutes before the hour. Let me thank you both. We really appreciate your individual time and PricewaterhouseCoopers support for us and the organization as we use this discussion of emerging trends to kick off what's next for real estate for 2026, which is the Councils of Real Estate full slate of compelling topical webinars. Watch your email for details, and you can always find information on our website at cre.org. On behalf of the Councils of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. And I want to wish you all a happy, healthy, and prosperous new year.